So, if you're a W-2 employee in the US, you've probably asked yourself this question at some point. Hey, can I write off that new laptop I had to buy for work? Or what about my home internet bill? Well, in this explainer, we're going to break down the real rules for employee expenses. And trust me, the answers might just surprise you. All right, let's just rip the Band-Aid off right away. Here's the uncomfortable truth. That laptop you bought for your job, your internet bill, for the vast majority of employees, none of it is deductible anymore. And if that sounds incredibly frustrating, you're absolutely right. And we're about to dive into exactly why that is. Here's the game plan. We'll start with that core uncomfortable rule. Then we'll look at the super simple standard deduction versus what I call the itemizing gauntlet. We'll get to a big aha moment when we compare employees to business owners. And finally, we'll wrap up with your smartest next move. So first up, why is this even the rule? It really all comes down to a basic assumption the IRS has about what it means to be an employee. Okay, so here's how the IRS sees it. Their logic is, if an expense is truly necessary for you to do your job, then your employer should be paying for it or at least reimbursing you for it. If they don't, then the tax code, especially after the big changes back in 2018, just considers that a personal cost to you. It's basically in the same category as your groceries or your rent. It's not a business expense you can write off. And this is exactly why more than 90% of all taxpayers take this next path. You know, it's simple, it's automatic, and honestly, for most of us, it's just the best deal out there. Meet the standard deduction. It's just a set dollar amount that you get to chop right off your income, no questions asked. If you're a single filer, that's a sweet $14,600. And if you're a married couple filing together, it's double that at $29,200. You get this huge tax break automatically. No need to save receipts, no tracking, no complicated math. It's the easy default. Let's see how this works with some real numbers. Imagine you're single and you made $85,000 this year. You just subtract that $14,600 standard deduction, and boom, just like that, the government can only tax you on $70,400 of your income. It's a massive instant benefit, and it's precisely why most people just stop right here. But maybe you're thinking, wait a minute, I have a ton of expenses. I bet I can beat that number. Well, if that's you, then you have to run what I call the itemizing gauntlet. You have to prove with receipts and records that all your specific allowable deductions add up to more than that big standard deduction. Let's see if we can do it. We'll start with medical expenses, which are a common one. Let's say your household income for the year is $80,000. Now, that number is really important because it's the starting line for a pretty tough calculation. And here's the first hurdle you have to clear. You can only start deducting medical expenses after they exceed 7.5% of your income. So on that $80,000 income, you'd have to spend more than $6,000 out of pocket on medical bills before you can deduct a single penny. Seriously, if you spent $5,999, your deduction is zero. So let's say you had a tough year and spent $9,500 on medical bills. You first have to subtract that $6,000 threshold you can't touch. That leaves you with a final deductible amount of just $3,500. So you spent nearly $10,000, but only $3,500 of it even counts towards your total. Okay, next up is the SALT cap. This one's a biggie, and it trips a lot of people up. SALT stands for state and local taxes. This includes things like your state income tax and your property taxes. But here's the catch. There is a hard cap of $10,000 total. So even if you paid, say, $14,000 in those taxes, you can only put $10,000 on your list. That extra $4,000, it just, poof, vanishes for tax purposes. Now, for homeowners, mortgage interest is often the single biggest itemized deduction. So in our example, let's say you paid a nice round $12,000 in mortgage interest for the year. The good news is that full amount can be added to our running total. And finally, let's say you were feeling generous and you donated $3,000 to qualify charities. As long as you have the receipts to back it up, that entire amount is deductible. Great! Okay, moment of truth. Let's add it all up. We've got our $3,500 in medical, state and local taxes capped at $10,000, our $12,000 in mortgage interest, and $3,000 to charity. That gives us a grand total of $28,500. So for a married couple, remember, the standard deduction is $29,200. After all that tracking, all those hurdles, and all those expenses, the simple, easy standard deduction still wins.
Now, hang on a second. Did you notice what wasn't on that entire list of deductions? All the things you probably think of as work expenses? You know, your internet bill, your cell phone, that brand new laptop, the home office space you carved out, your commute to work, even professional certifications you paid for.
And that's the bottom line. For a regular W-2 employee, none of those things are deductible, period. They were completely eliminated as itemized deductions a few years ago. You just have to eat the cost. So this probably has you wondering, why does it feel like my friend who's a freelancer is playing a totally different game? Well, that's because they are. And this brings us to the real aha moment of this whole system. You see, the tax code is intentionally built with two very different paths. As a W-2 employee, you get the huge benefit of a stable income and predictable taxes. But the trade-off is you get very, very few deductions. A business owner, on the other hand, takes on way more risk, but in return, they unlock a whole different world of deductions for their legitimate business expenses. We're talking the home office, mileage, equipment, you name it. Okay, so if you're an employee and itemizing is pretty much out of the question, what is the smart move? It's all about shifting your focus to a different and frankly more powerful type of deduction. These are often called above-the-line deductions. And the magic here is that they lower your taxable income before you even get to the standard deduction. Two of the absolute best ones are the deduction for student loan interest and any contributions you make to a health savings account, or HSA. Just look at how powerful this is. You start with that $85,000 income. Let's say you smartly contributed $4,000 to an HSA this year. That comes right off the top, lowering your adjusted income to $81,000. Then, from that already lower number, you still get to take your full standard deduction. It's like getting a deduction on top of your deduction. And that brings us to the ultimate strategic shift. If you really want to access that world of business deductions we talked about, the way to do it is to have a legitimate business. Even a small side hustle, freelancing, doing some consulting, anything that generates real business income can allow you to start deducting the portion of your internet, your phone, and your home office that's used for that specific business. You get to start playing by a different set of rules. So the goal here isn't to find some secret loophole. It's to understand the rules of the game you're actually in. For most employees, that means maximizing that standard deduction and those powerful above-the-line deductions. But it also raises a much bigger question, one for you to think about. Now that you understand the rules, are you playing the right game with your finances?